Okay, so I'm just going to dig into this. So second lien HELOC, that's why we're here. You guys know that we now have a product that will allow us to get a home equity line of credit in second lien position for, drum roll please, investment property. This has been something that's kind of been not available, widely very much desired by investors, but it's just not been something that we can find, at least over the last couple of years. I know that there have been a few outfits out there, not specific to Ridge, but PenFed, for example, Bank of the West, I think, had it for a minute for investment properties. The criteria to qualify kept getting more strict and more strict as capital markets and credit markets started to constrict as well. It just became less available. And then out of, probably the last 2-ish years almost now, gosh, we're almost at the end of 2023, I'd say they just are non-existent. They just haven't been out there for investment properties. Well, we're starting to turn a corner. Like real estate on its own, lending is also cyclical and it's changing on a dime all the time. So today I'm going to kind of give you guys an overview of what is available with regard to this second lien HELOC. And Carly, we're recording, right?
Yes.
Okay. Thank you, dear. With regard to the second lien HELOC, I'm going to give you the guidelines. I'm going to give you some of the rates and how you're going to be calculating those. I will preface by saying that for most investors, I'm going to tell you that the LTV, the CLTV, that stands for combined loan to value, is probably going to be on the lower end of what we would hope for. So I think it's going to play a lot of people out of accessing this. I think it won't be as available because of that CLTV, which is 60% max on an investment property. On a primary residence, we can go to 80%, which is great, but there's other options for primary that we even have access to that will allow us to go higher than that 80. Anyway, we'll get to that. We have some alternative loan products that we will also talk about today too. If that 60% CLTV plays you out of gaining access to this product, we can talk about some HELoans. HELoan, different than a HELOC, is a fixed rate second lien HELOC. It's just the same as your first lien fixed mortgage. It's just second lien position, 30-year fixed, and a HELoan, which offers higher LTV. So we'll talk about that. And then we're also going to take a minute. We're going to talk about the all-in-one, which for most of you that have heard me speak or listened to any of my podcasts or read any of my writings, the all-in-one is my absolute favorite loan product. Hands down on the planet, my favorite for the right individual, but especially if qualifications are there for real estate investors. And I'll touch on that as well. So let's talk about this guy. Let me get my cheat sheet because it is a newer product for us. So like I said, 60% CLTV and the interest rate, which is, I know what everybody is concerned about. We can argue about that on one-on-one for anybody that wants to get into that conversation. It really shouldn't be your focus, especially if the purpose of harvesting equity is for future investments. But let's just get that out of the way. So largely dependent on the FICO score, 60% LTV on an investment property up to 4 units is going to be based on prime, which is very typical for HELOCs, different than the all-in-one, by the way. The all-in-one index is based on the 1-year CMT. This product is based off of the Wall Street Journal Prime. Most of you have heard that term. Currently, Prime is posting at 8.5%. I encourage everybody, if you're going to be looking at an adjustable rate mortgage, I encourage everybody to go back and look at the historical value of that index. There's lots of indices out there. Prime would be one. The 1-year CMT, which is the US Treasury, and what the all-in-one is tied to. The Fed fund rate, which is in the news all the time now, is an indice. Okay, so what I would encourage you to do is do a Google search. Dear Google, Prime Index, or the 1-year CMT, or the Fed fund rate. And what you're looking for is the data that will show you an average. Okay, you can get it, and it's very easily attainable. You can go back 20, 30 years in the past and be able to see every single month, maybe even down to the day, they have that data out there if it changes that often, how the index moved. So what you're looking for is 2 things. How often and by how much did that index move to kind of illustrate, is it a very volatile index or is it relatively slow moving and stable? And then you'll be able to look for an average, let's say a 25-year average of that particular index. And that should be helpful because when we talk about an adjustable rate mortgage, it's not going to stay the same, right? There's two components on any ARM, adjustable rate mortgage, one of which is the index, which I just touched on. The other is the margin. Now, a 180 to the index, which is variable, it can move. The margin is fixed. It will never change for as long as you have that particular loan, that margin is fixed and cannot move. Adding those two numbers together will give you your fully indexed rate and what the interest accrual will be based on. Now, there's some other details about an adjustable rate mortgage, like caps and things. In this case, we're really only going to focus on the life cap, and that's in part of my talking point, so I'll get to that. But just to clarify, adjust rate mortgage, any HELOC is going to be adjustable. This particular HELOC is based on prime as the index, and the margins will be as follows. So I'm going to focus on the non-owner occupied, okay? And if you guys have questions about a second home or an owner occupied, you can ask those in the chat. Carly will be monitoring those, and we can get into those specifics as well. So credit score largely dependent, let's say 780 and above, 60% combined loan to value. We're talking about prime plus 2.75%. Okay, so 8.5 plus 2.75. I'm giving you guys time to do the math. That would be your fully indexed rate for that particular HELOC. Okay. Now, when we go down to 740 to 779 as a credit score, that'll be the benchmark, right? There are going to be tiers. The margin increases. The lower the credit score, the higher the margin. So the first margin is 2.24. Okay, let's just round it to 2.25. There's a 0.5 point hit for the non-owner occupied side of this. So that's where I got the 2.75. That was probably TMI. I could have just kept it at 2.75. So 2.75 is the margin plus 8.5 for 780 and above credit score. 740 to 779 credit score is going to be 3.5 margin plus 8.5 as the index of prime, which again is where it's sitting. What happens when the index goes down? Does your interest rate go down? Yes. Okay, there are things, the life cap, and there'll be a floor. The life cap means that no matter where the index goes, there's a maximum to how high that interest rate can go. And the floor is the reverse to that. Okay, the flip to that coin. No matter how low the index gets, there's going to be a minimum interest that will accrue independent. Okay, 700 to 739 is the next benchmark in credit score to figuring out what the fully indexed rate, index margin added equals fully indexed rate. The minimum credit score required for non-owner occupied on this product is 700. So if you have below a 700, you're not going to qualify for this. So I'll do it again real quickly. I'll recap what I just said. But 700 to 739, if you're within that window of credit score, it'll be prime plus 4%. Okay. Prime is currently sitting at 8.5%. So I'm going to say it one more time. 780 and above, this is all investor. Okay. If we want to talk about the owner occupied in the second home, you guys will ask those independently. 8.5 plus 2.75 at 780 and above. 740 to 779, you're going to be at 8.5 plus a margin of 3.5. And at 700 to 739, you're going to be at prime 8.5 plus 4% as your margin. Okay. Any comments, questions so far just about that part? Because I promise you, if you've got other random questions, I'm going to have you hold those for a second because I'll probably cover it within the rest of this conversation. Okay. Anything under a 700, you are not qualifying on this product for an investment property second HELOC. Okay. All right, let's talk about the terms. This is a 5-year draw, interest only. So what that means is that you're going to have access to the full line for 5 years, unchanged, interest only. And then after that 60 months has elapsed, it's going to turn into a repayment period. You no longer have access to the line. Whatever the balance is at that point in time, And that fully indexed rate is going to be based off of the payment principal interest now is going to be based off of a 25-year amortization. Okay, so you'll take whatever the balance is, interest rate at that point in time is going to fix, and it's going to be calculated over the remaining 25 years or 300 months, full principal and interest payment. Tennessee, there's an exception in Tennessee for some reason. I'm not sure why, but if the property were in Tennessee, it will be 5 years interest only with a 15-year repayment. So same thing applies, but it'll be 180 months that the amortization principal and interest will be based off of. The max debt to income ratio to qualify for this product, it is full doc. It's not a debt service coverage ratio. You have to qualify based on your income and your monthly liabilities. The max is 50% debt to income ratio. The loan amounts can go as low, or line limits can go as low as $35,000. That's the minimum, up to $250,000 in second lien. If you were to use this product, which you can on a first lien basis, still minimum would be $35,000 line limit. That's the minimum. Up to $500,000 would be the maximum on a first lien basis. And the other thing about that, and this is important, the minimum draw at closing is 75% of the limit. So if you had a $100,000 line limit based on the calculation of the value and the CLTV, reminder that's combined loan to value. Let's say that the line limit were 100 grand, you would have to, let's say, and you didn't own, you didn't have anything that we were paying off, right? Let's say, for example, you had a second lien already and we might be replacing that with a new loan. Chances are it'll just be, a brand new line that doesn't have anything that we're replacing it with, or we're not paying anything off. The minimum draw is 75% of the limit. So again, 100,000 is the limit in an example. You'd have to take 75,000 at closing as a condition of this loan. Now you can repay it and put it right back afterwards. There's not a problem with doing that, but just know that at closing, you're going to be taking that 75% minimum draw. As I said earlier, this is applicable to primary residence, second home, and investment property. There is a limitation to how many finance properties you can have if it's going to be investment, which is 10. You cannot have more than 10 finance properties and qualify for this loan. You can close in a trust. It's got to be revocable. You cannot close in an LLC name. Now, what I would tell you is, and read your loan documents, you guys. Okay, this is going to be important. If you decide to transfer title ownership into an LLC after the fact, you're going to be signing a legal document that says you don't intend to change title ownership, and that if you do, due on sale clause, right? Most of you are familiar with that term. I would say that the Fannie Freddie rules, and most are going to occupy this ideology. As long as you are the majority owner of the LLC, you should not have any issues in doing so, in transferring back into the LLC. Valuation and appraisal. So loan amounts that are going to be $200,000 and above are going to get an AVM. There's also a property condition report that we're going to require. I'm not going to get into that. I'm sorry, did I say greater than? I think I said greater than. I'm sorry. 200,000 or less, we're going to do an automated valuation. Okay, so we don't require an appraisal. If it's over 200,000 or 200,000 to 500,000, we're going to do a full appraisal or an automated drive-by. Okay, now you can choose. The cost for a full appraisal is going to be more expensive than that of an automated valuation or a drive-by valuation. But if you think there is some value in getting the full appraisal, let's say that there was a bunch of renovation or rehab that was done recently to the property, you probably want that full appraisal, because chances are the comps out there that it might be comparing to, the comparables, may not have some of those upgrades that could increase the value. So given the circumstances, and feel free to talk to your dedicated loan specialist about this, the full appraisal might be to your advantage if it's going to get you the value, the higher value that in turn is going to get you the higher line limit. Win-win. Okay. Title insurance, second lien HELOC. Video, you don't need to know all that. I'm looking at my cheat sheet, you guys. Okay, so let me go over some other additional details that will be helpful. If we have an appraisal, we can use it if it's within 12 months old. Within 12 months, we may request that it be recertified, which means the appraiser is going to have to, we take the report and the appraiser is going to have to recert it, saying that the value is still at the level that it was when it was originally done. If there's a fee to recert it, you guys will be responsible to pay that fee. I already talked about the minimum credit score for investment is 700. Minimum for owner occupied is 660. The fees on this loan are based on the line limit, not the initial draw, which is a little bit different than some HELOCs. Some HELOCs are going to be basing fees off of the initial draw. Not the case here. The fees will be off the line limit. We are going to charge 2% of the line limit. That's going to be our compensation. There's obviously no prepayment penalty on this. The other fees are going to be roughly $300, $300 to $500, I would say. So factor that in. That's going to include notary, the AVM, if we're not doing a full appraisal, credit. There may be some additional in-state attorney fees that aren't going to be within that $500. So just FYI, every state's going to be a little bit different. And then title insurance itself will be needed only for loan amounts over $250,000. Okay, so that additional cost would only apply after $250,000. Let's see. We already know we can do 1 to 4 units. We talked about that. Okay, so the loan and line over 125,000 are going to require a full appraisal or the AVD. Well, I already talked about that. We don't need to go back over that. The rate cap on this is 18%. So no matter what happens with prime, because that's the index that this loan is going to be tied to, no matter what happens with that, your rate, if you have this for, the 5 years, the first 5 years, whatever, it can never exceed 18%. That is your cap. I don't see the floor on here. It might actually be prime. I might have to double check on that. So I'll make myself a mental note and we'll blast that or put it within the community and let you guys know what the floor rate on these are, because I don't see that in my notes. So let me take a quick pause before I get into anything else and let's open up for questions, Carly.
Sounds good. Please put your questions in the chat box. John and I have been speaking directly, so we have that all sorted out already. But anybody else that has a question about anything Miss Ridge talked about, pop it in the chat and then we will discuss it.
No takers, no questions. Okay. Well, okay, just get them in there and Carly will interrupt and give them to me and I'll answer them. Let's talk about alternatively. So if that 60% CLTV, which I imagine is going to be a deterrent for a lot of people, if that is the case, if you don't have a 60% combined loan to value, and just in case somebody's not familiar with that term, CLTV or combined loan to value, I'll give you an example. Let's say that the value of the property, I keep it easy with easy math, value of the property is 100 grand, okay? And you owe on your first lien mortgage $50,000. That means you would be eligible for a HELOC, should the minimum be this low, of 10 grand. Okay, 60% of 100,000 is 60,000. You owe 50,000, so that has to come out of the mix, leaving you with a $10,000 available line of credit. Now, in this case, our minimum is 35,000, so that example wouldn't be applicable. I need to come up with a better example.
Hey, Caeli, sorry.
Yeah.
We just have a question here. The rate cap won't increase higher than 18%?
That is correct.
Okay. Perfect.
Yeah, that is the life cap. So if the CLTV is going to be a deterrent, which I do expect is going to be the case for most people, let's talk about the alternatives. One, you've got your owner occupied. If you don't have a HELOC on that, that's going to be an option. We can go, I think we've got a product that lets us go to 90. It might even let us go to 95%. I might have to double check that. So much higher leverage on a primary residence than you're going to find on a non-owner occupied. And we have products available for second home as well that likewise are going to come with higher leverage than the non-owner occupied will, the investment. So there's that. Let's talk about our second lien HE loan. Okay, reminder, this is a fixed rate second. Just like your first, it's a 30-year fixed rate. The differences are between this and a HELOC is that it's closed-ended, right? A HELOC is open-ended. You can draw from it, you can pay it down, you can draw back from it, right? Within the terms of the loan. In this case, it would have been a 5-year interest only, et cetera, whatever the terms of the loan are. A HE loan is closed-ended, just like your first. So when you pull cash out, you're getting all the cash at once, and interest accrual will start immediately, and your payments are scheduled, regularly scheduled, principal and interest based on the HE loan amount over a 30-year period of time and the interest rate associated with that. Okay, that will let us go to 85% CLTV, much higher than the 60% here. I would say, and the interest rates are going to be, gosh, depending on some variables, I'm going to say the interest rates are going to be on the HE loan, 85% CLTV HE loan, 10 to 13%. So they're going to be higher in many cases. But remember, you guys, I know I'm beating a dead horse here. You have to do the math. Okay, figure out what the numbers are. What is the value of your property? Baseline that. Gather as much data as you can, remembering that the appraisal is going to be the end all be all. Okay, the appraisal is going to tell us what's what. But go to the MLS. If you have an agent in the area or a turnkey or whoever you bought it from, maybe they can help you pull some data. Redfin, Zillow, you've got lots and lots of access. They've become much better at baselining average values than they used to be. Back in the day, Zillow would be the last place I'd ever go to try and baseline or value a property. They were all over the place. They've done a much better job within their algorithm. So just gather as much data as you can to get yourself that baseline, put them all together, and then get yourself an average. Now, if there is a lot of renovation or recent upgrades, rehab to the property, you're going to need some additional help. You're not going to get that from the ones and zeros that you're going to find online. They're not going to know that information. So baseline of value, do the best that you can to compile that information, okay, times 85%, subtract out your first mortgage, then that's going to leave you with the loan amount that you would be securing. And for argument's sake, use a rate of 13% over, and you can get a mortgage calculator anywhere online, over 30 years, figure out what the principal and interest payment is on that, okay? And then obviously taking the proceeds and redeploying them for an investment elsewhere, what is your return? And it's not as simple to just leave it there. You don't want to just stop with, okay, my payment on this HE loan is going to be $500 a month. The return from taking this capital, this harvested equity, and putting it back out there to work for me is only $300 a month. I'm in the whole $200 a month. Now that may be the ultimate decision maker, but you need to continue to think it through. What are you getting in return? You're giving up $200 a month. You have to float this thing $200 a month. Maybe the property that we're taking this second from can cover it. Okay. Now we're getting additional credit write-offs. We have more interest that we can claim. We're getting another property that will have additional tax incentives, plus potentially some appreciation, not only in the value of the home, but also rents, which you should be appreciating rents on any property that you have. So over some time, you probably be able to increase or rather decrease that $200 delta that I just gave an example for, right? So there's all of those other factors to be aware of. So if the numbers today don't look as favorable, make sure that you're looking at the big picture. What am I getting? What am I giving up? Does it make sense? And if it doesn't, it doesn't. But don't just look at that one aspect, right? You have to broaden the lens a little bit. Okay. So 85% CLTV, that should make sense to everyone. Let me know if you have any questions about that one. And then finally, let's wrap up with the all-in-one. The all-in-one, for those of you that are not familiar with this concept whatsoever, I'd like you to email me or us directly and say, I would like to talk about the all-in-one. I'd like to understand it more. We'll get on a one-on-one Teams call or Zoom call, do some screen share. There's an interactive simulator that's very cool that will tell you immediately, clearly, whether you are a good candidate for the all-in-one or not. Now, the all-in-one, let's start by saying it is a first lien HELOC. So whatever mortgage you have right now, this is going to replace it. And before you say, I'm not giving up my 3% rate, or I'm not giving up my 3.5% rate, or whatever it is, I would greatly encourage you, again, to do the math. You guys, I'm at this all day long, right? I mean, there's a ball and chain under my desk. I'm here 24/7, and I run these numbers all the time. And you will be surprised. I'm not surprised to see that very often, I'd say 60+% of the time, the majority of people that got those amazing interest rates in 2020, 2021 at 3% or whatever it is, the all-in-one is kicking their asses. And the math will not lie. The math will be the math. As long as the input, what we're putting into this simulator that I keep talking about, is accurate, right? The data that you have given us to say, this is what the value is, this is the rate that I'm paying currently, this is how long I've had the mortgage, this is the amount of income I've got going into my accounts, here's how much is going back out. As long as that data is accurate, the results of the simulator will be accurate. And you'll be able to say, wow, how can that HELOC at 9% or whatever it is right now be beating my 3% fixed rate interest? That's a longer conversation, but it does. I've seen it. It's not smoke and mirrors. It's not pie in the sky. It is a reality. It is a scientific math problem. And if you haven't done the math, you are at a disadvantage. You are leaving money on the table. You are leaving equity untouched that could be working for you out there in the market. And if the response is, well, I can't find a deal that works, then you're looking in the wrong market, because they're out there. Again, from my lens, I have that unique lens because we're licensed in 48 states. We work largely with investors. So in addition to talking about the all-in-one and running the simulator constantly, guess what else I get to see on a day-to-day basis all day long? I see the appraisals. I see the leases. I know what some of the returns are. The deals are out there. You're just going to have to look for them, right? This is not to 2020, 2021, the expectations need to change. The returns are not going to be the same. They're going to be different, but there's still returns that are viable, and they're out there. All right, I'll get off my soapbox about that. The all-in-one, very valuable tool, and we haven't really even gotten into the mechanics of it or the real advantages of it, which there are many. Significant reduced interest accrual over the life of the loan, the ability to have a 30-year line of credit. Yes, 30 years you'll have access to this thing. And it's a first lien, so the line of credit is typically going to be much higher than if it was a second lien line of credit. And then finally, having access to this thing for 30 years, in many ways, it creates a scenario where you become your own bank. You're not having to go back to the well every time you want to harvest that equity. It's now at your fingertips to draw on how you want, when you want, for what you want. You're not pre-qualifying and going through everybody's favorite process, the loan process. You're not having to pay closing costs again every time you want to do that. So the all-in-one, for that reason, and many, many more, I'm a real fan. So make sure that you are exhausting that possibility for yourselves, and that it is or isn't a fit. Okay, do your own due diligence and your homework. All right, I'll shut up now. Carly, do we have any questions?
No questions.
Wow, you guys are taking it easy on me today, really? Okay. If anybody wants to do a one-on-one on the all-in-one or a HELOan or second lien, owner-occupied, non-owner occupied, HELOC, whatever it might be, all you need to do is email info@ridgelendinggroup.com. The lovely Carly will schedule us a time that's convenient for our schedules, and we'll do a Teams call, and we'll dig into it and figure out what solutions we may be able to offer you that will propel future financial freedom, right? That's why we're here. That's why we're sitting here today at 1:32 Pacific time on a Wednesday, is to figure out how we're going to gain that passive income to create the lifestyle that is what we're after. Did I see a question come through?
Yeah, one
Okay.
came through. So Andrew asks, what is max combined loan to value of the all-in-one?
Thank you, Andrew. Yeah, I failed to say that. So for an owner occupied, it's 80%. I think it's owner occupied and second home, 80%, regardless of transaction type. So whether, actually, I think that they just changed it for the non-owner too. So purchase, rate and term refi, cash out refi, 80%, owner occupied, second home, non-owner occupied is 70%. Thank you for the question. What else, gang? Well, what about not about this? Does anybody have anything that is top of mind? Any questions about? Oh, I've got one. I'm certain that somebody, even if they might be in the middle of typing this right now, what are interest rates going to do this year or next year? Right? That's all anybody wants to talk about. Okay, I've pulled out my crystal ball and I'm going to tell you that interest rates have improved over the last gosh, has it been a week or 2 weeks? The Fed's met. Was it a week ago? Maybe it was 2 weeks ago. I'm in a daze. The Fed's paused again, second month in a row. They did not increase the Fed fund rate. The lag information that they receive about all the macro and microeconomics that go into figuring out where the inflation rate is, where they think it's headed. The data points looked favorable, so they paused. Jerome Powell, who is the chair, Fed Fund chair, has been extremely clear about their objective, and that there is nothing that tells them that they're done raising interest rates, and that they are dead set on hitting that 2% benchmark of inflation. I'm not really sure I could explain why that was chosen. I don't know. I've asked a couple of different people, what's with the 2%? Why is that the benchmark? And I haven't really gotten a good answer, and I don't have a good answer for you. So as a result, secondary markets have their own unique way of interpreting what the Feds say and what the Feds do. Okay, so they met and they did not raise the Fed fund rate. They paused it again for the second month in a row. So secondary markets will build in based on their appetites and what they think is going to happen. And they're not always right, but we've seen interest rates pull back a little bit. We've seen some reprieve from as a result of that. So maybe it's 1/4 percentage point. Maybe it's more about the points. If you guys have gotten any fee sheets or quotes, or you've closed on any loans at all this year, you've noticed that you're paying much higher in the points department for closing costs, right? If you're interested in this, I can go into it, but it's called premium pricing, and there is no premium pricing. We're in a high rate environment, and what that means is that we're going to have a runoff. The servicers that are purchasing these mortgage-backed securities know that these loans in the next year or 2 years, et cetera, are going to be refinancing when rates come back down. Because when they go up, do interest rates stay up? No, they do not stay up. When interest rates are low, do they stay low? No, they don't. They're a very fluid, dynamic thing. So secondary markets know that interest rates are going to be coming back down at some point in a month, 6 months, a year. I'm not going to get into that point, but when that happens, it'll be a runoff. Okay. Servicers, it takes them 3 years to become profitable once they have retained the servicing rights of that mortgage-backed security. They purchased that mortgage-backed security, and as a result, they paid a premium for it. It's going to take 36 months for them to become profitable or in the black. They know that the mortgages that they are purchasing the servicing rights to are going to be paying off before the anniversary of their profitability. So that's why they're hedging. That's why you're seeing those extra points on transactions, loan transactions that you have been closing. I would say mostly this year. Point is that for interest rates, don't just look at the interest rate necessarily, because we have seen some improvement, especially since the last Fed meeting, but it could be a combination of the two. A reduction in points and or interest rate, right? So maybe it's 1/8, maybe it's 1/4, but also the points associated or to get that interest rate are probably starting to reduce as well. Long term, I think that I'm in the camp that I think 90% of the smartest people in the room would agree that rates are going to come down. Now, they historically come down much slower than they go up, especially with how quickly we saw them go up from March last year to now. That was unprecedented, but they're going to come down. Remember, when we talk about interest rate, which is everybody's favorite topic, the largely dependent on the loan size, and this is important. So if you guys are out there listening to me right now, whatever you're doing, stop what you're doing. I want you to focus on this. Largely dependent on the rate or the loan size. Okay. The difference in your principal and interest payment, let's use 1/2 point because it's a nice round number, on 100 grand might be $30 a month. It's more often than not a much lower number when they look at it in black and white, when they do the math, than what psychology tells them in their head a half a point translates to. So if you're sitting on the sidelines and you're within, let's say your model is investment properties in the 70,000, 75,000 to 200,000 mark, let's just use that as a range. If you're sitting on the sidelines waiting for interest rates to come down, you may be disappointed because the difference in payment for a half a point, and it's not going to happen overnight. When interest rates start coming down, it's not going to be the kind of thing where we wake up the next day and we go from 8% interest rates to 5% interest rates. That'll take years. And in the meantime, what are you missing out on? What are you giving up? Appreciation, increasing your rents annually by a very modest 3%. Most markets are well and above over that. You should be appreciating at 5, 6, 7%. Okay, I'll get off that soapbox too. Anybody have any other questions before we wrap this up?
We do have
interest rates are coming down.
We do have a couple more here. Dawn asks, what's the credit score for the investment home loan?
The investment home loan. So Dawn, can you be more specific? You mean just like a 30-year fixed purchase, like a Fannie Freddie loan? Feel free to unmute yourself, Dawn. I think you can.
I think I'll do it for him here.
Yes, it's Rich, thank you. Yeah, I didn't hear you say anything about the credit score. I know you said the credit score for the CLTV was 660. I want to know what it is for the other one, not the HELOC, though, for the home loan.
For the HE loan, you mean the second? We're talking about the second
The
lien,
HE
Don, or are we talking about the
ma'am.
second lien? Okay, the second
Yes.
lien. Yes, I should know that. And I think that the credit score on the HE loan goes down to as low as on a non-owner occupied. I'm going to say 660. If someone can distract, does anybody have a joke? I can pull it up and tell you right now what that is. Give me 1 second. Let me just keep talking.
Oh, we got it here from Bianca. Thank you, Bianca. 640.
Ooh, 640 to 85% CLTV.
640.
I think it's, yeah, Bianca,
640,
yes. So
yes.
640,
Okay.
as low as 640 up to 85% CLTV. Just keep in mind, gang, that that lower credit score, you're going to take some hits in the rate. You're probably going to be, I think I said earlier, the range of 10 to 13%. At a 640, you're probably going to be 14, 15%. So be prepared for that. Do the freaking math.
Okay, thank you.
You're welcome, Don. Thanks for the question.
All right, perfect. So Bianca did say it is 70% CLTV.
At the 640?
Yes, at the
That
640.
seemed a little low. Okay. So Don, do me a favor, just email me. Okay, email info@ridgelendinggroup.com. Give us your scenario and we'll get you a proper quote. We'll give you kind of a rate range and what you can do, sir.
Okay, I'll give you a call and I'll email you as well.
Okay.
You know I'm a client of yours already, so I'll be in touch.
Wonderful. Thank you so much.
You're quite welcome.
All righty. So we do have another one here from Andrew. So is a condo hotel investment unit eligible for your loan products?
Some of them, yes. So it's going to depend on the loan product. We have some non-QM products. Non-QM, for those that are not familiar with that term, stands for qualified mortgage. QM, qualified mortgage. After the 08-09 crash, the sweeping Dodd-Frank legislative rules that came about of those were QM, ability to repay, ATR, and QM. Qualified mortgage, in simplistic terms, is the equivalency of a Fannie Freddie. It's a conventional loan. So everything outside of those guidelines, underwriting guidelines, are now deemed non-QM. Non-QM in and of itself is extremely diverse. It can be for owner-occupied or non-owner occupied. It's not just for investors. There's bank statement loans in there. There's asset depletion loans in there. Their credit criteria for credit issues like bankruptcy or things like that, short sales and things, are far less restrictive than, say, a conventional loan would be. Credit scores, reserves, everything. There's a lot more going on or available in the non-QM space. And condotel is definitely one of those things. Do you have any specific questions? I'm sorry, I forgot who asked the question about condotel that you had that we can try and answer.
That is Andrew, and Andrew, feel free to unmute.
Would it qualify for the all-in-one?
Yeah, on a case by case, the all-in-one will look at condotels on a case by case. We'll need to get more data, Andrew, but the all-in-one does consider them, but like I said, case by case.
What's the rate again on the all-in-one?
So it's the 1-year CMT. This is the US Treasury plus 4% is the margin. So I think that this month, and it recast the first of every month, I think November 1st, it went down just a little bit. And I want to say that it's 5.41. It was at 5.46. I might be off by a basis point or two. So the fully indexed rate is going to be 9.54, I think, if you add those two. Now, please, when you guys hear that number, I implore you to run the simulator. And if anybody wants a simulator, just email info@ridgelendinggroup.com. We'll send you the link to the simulator. Please go in there and put in your data. If you have questions about what the data input is asking, you're not really clear. Hey, what does it mean when it's asking me for this? Let us know, because if you got bad information in, what's going to happen to the results? They're not going to be valid, right? So I think there's some real value in doing some one-on-one sessions. Again, no pressure. It's, my time is valuable, but I'm willing to do that with you for free. But when you hear 9.5%, people just shut down. It's velocity of money, you guys. I'm going to give an example. This resonated with me when I was first learning about the all-in-one, which, by the way, the learning curve is steep. Okay, you got to take some time and really peel it back to understand it. If it took me 2 weeks to understand, be generous with yourselves and take the time. So here's the example that I heard that was useful to me that kind of connected a few dots. I want you to think about time and money. Okay, take a 30-year fixed and a 15-year fixed rate mortgage. Both of these have balances of $400,000. They both start with outstanding principal balances of $400,000. Okay, the 30-year fixed locked at 4%. The 15-year fixed, which, by the way, is 180 months versus 360 months. Okay, the 15-year locked at 7%. Which one are you going to pay more interest on? 4% or 7%? It's not a trick question. It's maybe a trick question. So you will pay more on the 4% interest over 360 months than you will a 7% interest over 180 months. And that is a very simplistic, abbreviated version of the explanation. Please don't think about the interest rate. This open-ended line of credit is more about what you have in depository access monthly from all sources. So the reason that this is especially beneficial to investors is because we have access to those gross rents, right? Before we have to make our mortgage payments, I may have access to $20,000 a month in gross rents before I have to send anything back out the door. Well, what I'm going to do with that $20,000 for 29 out of a 30-day billing cycle, monthly billing cycle, is I'm going to drop this in against my open-ended revolving line of credit, my all-in-one, and I'm going to reduce that principal balance dollar for dollar by 20 grand, so that the interest accrual is now based on whatever less 20 grand was for 29 days out of a 30-day billing cycle. On that 30th day, that's when I'm going to send off my payments, right? So my balance will go up for a day of the month. Hopefully some of that makes sense. It's tough. There's a lot that goes into it. That one-on-one discussion, I think, is very useful. The simulator is magical because it allows you to have that visual aid with it that I really think a lot of people appreciate, and allows them to conceptually start to retain some of that. So stop thinking about the interest rate and do the math. Thank you, Carly. What else, you guys? Come on, you got me for another minute or two. Anything? No dumb questions. Doesn't matter what the content is. It could be about a market. It could be about short-term rental, long-term rental. It could be about ARMs or interest only, or it doesn't matter. Bring it. What do you got? I'm going begging. Okay. Nothing? All right, gang. If you need us, guess what? We will be here on standby. There's all these ways to reach us. Our website is Ridge Lending Group. Oh,
We got one here. Why aren't ARMs a good option right now?
thank you for that question. Adjustable rate mortgages not on a HELOC basis, The HELOC is going to be a little bit different because it's open-ended and it's interest only. The traditional ARM, adjustable rate mortgage, let's use the most common for mortgage, a 5-year ARM, okay? Those are not viable right now because we are on what's called an inverted yield. This started in 0809 after the housing and lending crash, SIMO crash. And it without getting too technical, it means that the 30-year mortgage or a fixed rate mortgage is going to produce a better or more favorable rate in many cases than the ARM. The only reason to even look at an ARM is if that interest rate is a half, I would say even a full percentage point lower than a 30-year fix. I'm a huge fan of an ARM, especially for investors, because statistics tell us that the average life cycle of a 30-year fixed mortgage for investors is about 5 years, 6 years. So if you know that, and under normal circumstances, if you can get a 5-year ARM or 7-year ARM or 10-year ARM, whatever it is, for a half or a full percentage point less in rate than a 30-year fix, why wouldn't you do that? Because as investors, what are we going to do with these properties? Are we just going to buy them and put them on a 30-year fix and leave them there to pay off? Not that one is definitely not a trick question. No, of course we're not. We're gonna buy and sell and refi and 1031 exchange, right? So the mortgages, how often can you, if anybody that's had a mortgage, whether it be on your primary residence or an investment property, I want to ask you this. You signed your loan documents, a 30-year fixed mortgage. And for those that might be old enough to have even done this, but how many of you have that mortgage still from when you signed those loan documents if it was more than 10 years ago? I bet you it's very, very small. The percentage of people that start on the first day of making that 360 payments later to pay it off that actually take that long is a fraction of a percent. Now, I would agree that because of the low interest rates everybody got during the pandemic, that percentage is going to go up a little bit, but not much. I guarantee you, mark my words, I'm going to put myself out there on a limb here, okay? I guarantee you those 2.5%, 3% interest rates for the vast majority of people. There will be some, but for the vast majority of people, they will not keep those loans for 30 years. They will be refinanced at some point. Okay. Wow, I'm froggy today. I'm kind of spicy. Okay, guys, call me, email us, info@ridgelendinggroup.com. Our website is ridgelendinggroup.com, 855-74-RIDGE, 855-747-4343. Whatever your questions and your needs, we are here on standby, truly always ready to help educate and support whatever your real estate goals are through finance and information. We'll see you guys soon. Carly, real quick, is there a live with Caeli next week? There is.
No, the next live with Caeli is going to be on the 28th of November. So stay tuned for that topic. And then please join us that day.
Yay. And we'll be back and on track to every other Tuesday after the first of the year. Year end gets kind of nuts. So I'm trying to save some of my sanity and some of Carly's sanity. So there's that. But I'll try and put out, as I think are timely, maybe some extra details in the newsletter that you guys are getting weekly. I hope you're looking at those. And if there's any topic that you would like us to touch on or have interest in, we're a phone call or email away, truly. I mean, how many lenders do you know that you have access directly to the CEO for questions and answers? I don't know too many. So use it. You guys have access to it. I'll see you soon. Thanks for coming and bye-bye.